Enphase is the leading supplier of microinverter systems for solar generation and energy storage. The company is undoubtedly one of the most successful and popular growth stories in the past decade, returning more than 10,000% ever since the stock bottomed in 2017. However, Enphase's growth story seems to be coming to an end, which is why the stock has been struggling lately, down more than 60% year to date, while the rest of the market is up nearly 20% for the year. With that said, in today's video, I'll be talking about Enphase's Q3 earnings results and why the stock has been underperforming lately. And full disclosure, I do have a position in Enphase, so you might want to stick till the end to find out what I'll be doing with my position. Also, if you prefer to read the article version of this analysis, you can find the link to my article in the description box below. If you don't have access to Seeking Alpha, you might want to sign up today as they're having a Black Friday promotion with 30% off for their premium plans. The sale ends on December 5th, so if you're interested, please use my affiliate link in the description box below as it really supports my channel. And with that out of the way, let's get on with Enphase's Q3 results. In Q3, revenue was $551 million, down 13% year over year and 23% quarter over quarter. This is at the bottom range of management's guidance of $550 million to $600 million, and this also fell short of analyst expectations by nearly $16 million. But more importantly, this is a shocking reversal in growth, which have been, 30, 40, 50% over the last few quarters, and this looks really bad for a company that is regarded as a high growth stock. They grew 69% year over year in 2022, and now Enphase declined by 13% year over year due to excess inventory with distributors and installers as well as high interest rates. As you know, the Fed pulled off one of the most aggressive rate hikes in the past 2 decades, raising interest rates by 500 basis points over the past year or so, from virtually 0% interest rate to now over 5%. This spike in interest rates significantly reduced affordability for major purchases such as homes, cars, and of course solar equipment, and that is why consumers are holding back on their solar installation projects as it is not a priority for them. As such, demand for solar products collapsed, and that is why Enphase has been struggling lately. As a result of high interest rates and lower demand, solar retailers and distributors are facing excess inventory, which forces solar manufacturers like Enphase to ship fewer units to channel partners, which translated to lower revenue. As you can see, Enphase's microinverter shipments declined 10% year over year to 3.9 million units and 7% year over year to 1,600 megawatts. And this is largely due to lower sell-through rates in 2 major regions. First, California sell-through rates were down 25% quarter over quarter due to the NEM 3.0 transition. If you're unaware, California introduced a new net metering policy earlier this year called Net Energy Metering 3.0, which basically reduces compensation for exporting excess electricity to the grid, which makes investing in solar equipment less appealing for California residents. Next, the European market is also struggling, with sell-through rates down 35% quarter over quarter. Enphase's 3 largest markets in Europe, which are the Netherlands, France, and Germany, were down 40%, 34%, and 32% respectively. On the other hand, Enphase's battery business remains under pressure as well, with 86 megawatt hours shipped, down 35% year over year. However, this is a slight improvement quarter over quarter, and management believe that the battery business is at an inflection point as sell-through rates continue to improve over the last few quarters. So that's good to hear. All things considered, Enphase is dealing with a few major challenges, including high interest rates, NEM 3.0 transition, and inventory oversupply, and this caused demand to dry up, which subsequently lead to negative growth in Q3. However, these are temporary macro issues that are beyond Enphase's control. It's not due to competition, mismanagement, or product defects. Eventually, interest rates will fall and the inventory situation will stabilize, and when that happens, demand should pick up once again and the company should be back in growth mode. As a result of falling revenue, gross profit was $262 million in Q3, down 2% year over year. Gross margin, on the other hand, continued to expand up 600 basis points year over year to 48%. This improvement is primarily due to a $14.5 million net IRA benefit as the company ramped up manufacturing in the US. It's worth mentioning that in Q3, Enphase shipped 531,000 microinverters from its contract manufacturers in the US, and management expect this figure to increase to 1 million in Q4, which should boost net IRA benefit and subsequently gross margin as well. Its newer IQ8 microinverters also make up 86% of total microinverter shipments in Q3, up from 78% in Q2, which led to higher average selling prices, contributing to gross margin expansion as well. Regardless, higher gross margins reflects higher earnings potential, strong pricing power, and economies of scale, which is always good to see. Jumping straight to the bottom line, Q3 net income was $114 million, which is a 21% GAAP net margin and a 26% non-GAAP net margin. Non-GAAP operating expenses remain flat quarter over quarter at $99 million, so spending is controlled, which is good to see given the challenges that the company is experiencing today. Overall, profitability margins look stable, but expect more pressure moving forward as the company navigates through the current macroeconomic storm. That said, Enphase is one of, if not the most profitable and capital-efficient solar player today, with an ROIC of 26%, which is way above its peers like SolarEdge, which has an ROIC of 7%. This shows that Enphase has better earnings potential, operating flexibility, and financial resiliency, and I believe that Enphase is the best positioned to deal with any challenges in the solar industry, and the company should come out stronger from this solar crisis while competitors struggle to remain profitable. Turning to the balance sheet, Enphase has $1.8 billion of cash and short-term investments with $1.3 billion of total debt, which puts its net cash position at about $0.5 billion. As you can see, net cash remains stable quarter over quarter, so no red flags there. On the other hand, its inventory balance continues to grow as channel partners face an oversupply of solar equipment. As such, channel partners are now focused on destocking their inventory before purchasing more of Enphase's products. This forces Enphase to undership its microinverters, which led to its own inventory buildup, as you can see right here. Days inventory outstanding also increased to 54 days in Q3, which is higher than the supply chain shutdown that we saw during the early days of the pandemic. This shows how serious the oversupply problem the solar industry is facing currently, so hopefully we can start to see these two metrics stabilize and improve over the next few quarters. Moving on, free cash flow in Q3 dipped as well to $122 million, representing a 22% free cash flow margin. And almost all its free cash flow generated in Q3 was used to repurchase shares. In Q3, the company bought back nearly 850,000 shares for $110 million at an average price of $130 per share. Given that shares are now trading at $98 a share and that the company still has $890 million left available in its share repurchase program, I expect aggressive buybacks in the next 2 quarters or so, which should minimize shareholder dilution. I believe share buybacks is the best capital allocation strategy today, since investing for growth and maximizing production is not a really good idea given the oversupply situation in the solar industry currently. Turning to the outlook, management provided the following Q4 guidance, which is a horror show to say the least. For Q4, management expects a revenue of $300 million to $350 million, which is a 55% year-over-year and a 41% quarter-over-quarter decline. That is just horrifying for a high-growth company like Enphase. And back in its Q2 earnings call, management mentioned that the company is taking a one-time correction for shipments and that they expect the channel inventory to normalize at the end of Q3. Well, management turned out to be completely wrong, as they expect approximately $150 million of channel inventory correction in the US and Europe in Q4. They also anticipate that undershipment will continue in Q1 and expect channel inventory to normalize in Q2 next year instead of Q3 this year. As you can tell, management provided really ugly Q4 guidance, which is why the stock sold off following Q3 earnings results. On the bright side, management mentioned that they're being conservative with their guidance with no demand recovery until Q2, so there's a good possibility that the company beats its own guidance. Regardless, management's big miss in terms of channel inventory normalization tells me that management does not have good visibility in the supply and demand dynamics of the solar industry, and that poor visibility is probably why investors are panicking. But moving on, management expects Q4 gross margins to be 46 to 49%, so assuming a midpoint gross margin of 47.5% and a midpoint revenue of $325 million, Q4 gross profit is expected to be about $154 million. They also guided for GAAP operating expenses of $142 to $146 million, which means that if we take gross profit of $154 million and subtract it by $144 million of GAAP operating expenses, GAAP operating profit is expected to be just $10 million in Q4, which is a steep drop from Q3's $118 million. If things turn out to be worse, which is possible given management's low visibility, Q4 could turn out to be an unprofitable quarter for Enphase. That said, interest rates need to come down for the business to improve. At the last FOMC meeting, the Fed agreed to maintain interest rates at 5.25% to 5.5%, which was the second consecutive meeting where rates were held steady. Fortunately, some early signs indicate that the Fed may be ready to cut interest rates. For one, the October CPI reading came out better than expected, indicating a 3.2% year-over-year inflation versus the 3.3% expected. Moreover, there was zero inflation month-over-month in October, which is less than the 0.1% increase expected and the 0.4% increase in September. Trueflation also shows that the inflation rate is heading lower in November with a reading of less than 3%. This is good news because the more inflation comes down, the more inclined it is for the Fed to cut interest rates, which is going to be a major catalyst for the stock. But until then, Enphase stock will continue to struggle in my opinion. Turning to valuation, Enphase trades at a forward PE ratio of 23 times, which is a big discount from its highs of 80 times and average of 40 times. While it may look cheaper, the lower PE is justified given management's extremely weak guidance. Here, I've taken screenshots of Enphase's revenue and earnings per share estimates. As you can see on the left, back in September this year, analysts were expecting revenue of $3.14 billion in 2024. That's 3 months ago, and today they expect revenue of just $2 billion, which implies a 12% year-over-year decline and a 37% downward revision by analysts. That's just insane, and we can see the same thing for earnings per share or EPS. Back in September this year, analysts were expecting 2024 EPS of $6.50. Today, they expect only $4.30, which is roughly a 35% reduction in EPS estimates. Put simply, the sell-off was justified and Enphase stock deserves the lower PE multiple. Nonetheless, sentiment seems really bad at the moment and results may turn out better than expected, which may re-rate the stock to a higher multiple. Given the weak outlook, increased uncertainty, and lower sales estimates, I'm also lowering my price target on Enphase. As you can see, I have a fair value estimate of $155 per share for Enphase stock, which is significantly lower than my previous estimate of $226. I still think the stock is undervalued, and based on the current price of $98 per share, I see a potential upside of 50% plus for Enphase stock. If you're interested in how I arrive at this price target, you can check out my article where I provide details on my DCF model. Again, link in the description box below. In other news, Enphase CEO recently bought shares at $90 per share, totaling $100,000. For context, the last time he bought shares in the open market was 4 years ago, so this could be a strong signal that the stock may be undervalued. Wrapping up this video, the last 2 quarters have undoubtedly been a tough quarter for Enphase. Growth turned negative due to excess channel inventory, NEM 3.0 in California, as well as high interest rates. To make matters worse, these ongoing issues seem to have a much larger and longer impact on the solar industry than management have anticipated. Fortunately, these problems are temporary, and given Enphase's strong competitive advantages as well as the long-term outlook of the solar industry, I think Enphase's growth story remains intact. Besides, the solar industry is a cyclical industry, and given the Fed's recent pauses in interest rate hikes as well as the lower inflation rates today, I think the solar industry might just be near at the bottom of the cycle. Soon enough, the Fed will eventually cut interest rates, and that will be a major catalyst for the stock. But in the meantime, as interest rates remain higher for longer, Enphase's stock will likely remain lower for longer. And as for me, I will continue to hold my position in Enphase stock. I won't be adding to my position though, as I think there's just too much uncertainty at the moment. With that out of the way, thank you guys for watching this video. If you do find value in this video, please leave a like, comment, and subscribe to my channel for more investment content like this. As always, I appreciate you and I hope you have an amazing day. See you guys on the next one.